It seems like everybody is waiting for interest rates to drop right now before moving forward with buying or selling a home. But what actually needs to happen to make this a reality? Let's go ahead and break it down. Okay, so before we start this episode, there's 3 things that you need to know in order to understand everything else that we're talking about later on. So let's cover those first. So number 1, the 30-year mortgage rate is most closely tied to the 10-year treasury yield. Over the last 50 plus years, these things have been moving up and down together pretty consistently. So anytime you see the 10-year treasury move, the 30-year fixed mortgage rate is going to follow. Now, the second thing you need to know is the 10-year yield typically reacts based on investor confidence, economic outlook, as well as the Fed policy. Not the short-term, but the long-term Fed policy. And then number 3, and this is more of a disclaimer, is that interest rates are the hardest thing to predict inside real estate in terms of where they're going to go. So we're going to be going over some of the major things that have been moving interest rates lately, as well as some of the minor things as well, to give you a better understanding of why they're moving, so when you're watching the news, you can have a better idea if interest rates are going to be going up or down based on what you're seeing in the news cycle. So the first thing to be looking out for is unemployment numbers. So the higher unemployment goes, the larger the risk of a recession is, and typically this means that the Fed is going to start cutting interest rates to help try to stimulate the economy to avoid a recession. Now, when the Fed start cutting interest rates, that typically starts driving investors into safer assets like the 10-year yield. And when people start to rush over to buy those 10-year bonds, the price of those bonds go down and mortgage rates tend to follow. So anytime we get those employment reports coming out and you see those headlines saying that unemployment was higher than expected, you can typically expect to see interest rates start heading downwards. The more those reports we get, the farther down it's going to go. So the second thing that will help drive interest rates lower is some certainty around the trade and tariff situation. Right now, it seems like every day there's a new headline about a different country, different tariffs. There's so much confusion right now that no one has any idea what's going to happen long term in both the US as well as global economy. And anytime there's long-term doubt in the US economy, you start seeing investors shy away from those long-term bonds, which is going to drive those prices up, which in turn is going to drive interest rates up. So if we start seeing deals being made with some of the major trade partners especially, it's definitely very possible you're going to see interest rates start heading downwards pretty quickly. Just to prove the point, I'm recording this on Friday, and about 30 minutes ago it was announced that next week the White House as well as China is going to sit down to try to start negotiate again with trade. And just with that headline alone, the 10-year treasury yield started to drop because more people started buying 10-year treasuries, which in turn is going to drop interest rates on the 30-year mortgage. So if we can get some clarity around all these different tariff situations, it's going to improve interest rates for anybody trying to purchase a home. Now, the third thing that could help drive interest rates down a little bit lower is going to be the current budgeting bill that is going through Congress right now. So based on the bill currently being debated right now, it seems like a large portion of economists are saying that it's going to add a significant amount to the deficit over the next 5 to 10 years, and investors are already concerned about how high the deficit is and how fast it's growing. So anytime we get news showing the deficit is growing in the United States, it's giving investors less confidence to invest in those long-term bonds, again, like the 10-year treasury, which is pushing mortgage rates up. So if we get a new version of this bill coming out after all the modifications that shows it's not going to significantly add to the deficit, that's going to be good news for mortgage rates because it will slowly start driving them down. So when you're seeing all the different news about the bill, that's definitely something to pay attention to and understand that it does have a direct impact on what mortgage rates are doing based on which version of that bill gets passed. Because if it gets passed as it is right now, interest rates will most likely stay higher for longer. If they can reduce that deficit spending, interest rates will most likely go lower. Now, out of the 3 different things I talked about, just one of them alone is not going to get interest rates to below 6.5%. All 3 of these things would need to line up perfectly to start getting interest rates back under that 6.5% mark, where it seems like a large portion of buyers are more likely to enter the housing market. Now, we saw that back in September when interest rates dropped below 6.5% for a few weeks. We had a flood of demand for buyers entering the market, multiple offers on homes, and the housing market heated up really quickly. So could all 3 of these things happen where unemployment starts to go up, we get some more clarity on the trade deals, as well as this bill gets changed to reduce the deficit? Definitely, but it's going to be hard to get there. Now, there are 1,000 other things out there that can also impact mortgage rates, which is why I gave you that disclaimer at the beginning, because there are so many different things in the US economy and global economy that can shift interest rates one way or another. For instance, inflation. So that's been a big talking point last year. However, this year, inflation is not completely under control, but looking at the last couple readings, inflation has come in anywhere between 2.1 and 2.5, depending on what report you're looking at. The goal of the Federal Reserve is to get that down to 2%. So we're not quite there, but we're getting pretty close. So even if inflation continues to fall slightly over the next couple months, it's probably not going to have a dramatic impact on what interest rates are doing, because Feds right now are more concerned with what unemployment numbers look like versus what inflation does. However, if inflation starts going back up again because of different tariffs going on or something else in the economy, that's definitely not good news for interest rates. It means the Fed is going to keep their rates higher longer, and you're much less likely to see interest rates fall anytime soon. So yes, it's still important to see that number stabilize or even come down a little bit, but as of right now, it's not a major factor in what interest rates are doing. And then two more quick things just to keep your eye on: geopolitical conflict. So anytime we see more conflict throughout the entire world, that tends to drive less long-term investment, which again is going to increase interest rates. And finally, if we see any type of major stock market correction in the near future, investors tend to pull money out of stocks in that case and start putting them in bonds. And if they do that, interest rates might also drop as well. So these are just a few things to be looking at, but if all of these things line up, there's definitely a case to be made that interest rates could get below 6.5% again by the end of 2025. However, in my opinion, it's probably not likely. If they do get there, maybe they'll be there for a little bit, but then shoot back up again. Most likely we're going to be stuck in the mid to high 6% range for the rest of the year. Now, all that being said, if you're watching this, most likely you're trying to purchase a home for your family. You're not an investor. You're thinking of buying a home and you want some place to stay in for 5, 10, 15 years. It's going to be a long-term investment. So it's something I say often on this channel, but you need to make sure if you're thinking of buying a home, you can't really time the market. It's going to be impossible. You're always going to lose. The best thing to do is look at your current finances, figure out if based on the current situation, if you're able to get into a house in the neighborhood you like with the amenities you like, and you can see yourself living there comfortably for 5, 10, 15 years. If so, these higher interest rates shouldn't prevent you from getting into the housing market, because if you get into the housing market and interest rates drop, most likely home prices are going to start going up again, and you can always refinance to take advantage of the lower rates, lowering your mortgage payments. And on the other hand, if interest rates go up and home prices start falling for some reason, guess what that does to your monthly mortgage payment? Absolutely nothing. As long as you can afford that payment, you can ride out any type of market fluctuation, because over the long term, it's been proven time and time again that if you hold your home, especially for 10 plus years, it's extremely unlikely that when you go to sell your house is going to be worth less than when you purchased it. So yes, I can never predict everything that's happening in the housing market, but the US housing market has always shown decade after decade, if you purchase a home and you're holding it for the long term, you're always going to come out ahead. Now, if you have been thinking of buying a home over the next 12 to 18 months, there's a bunch of free resources down in the description below if you're watching this on YouTube. Feel free to take advantage of that, or you can watch one of these two videos right here, which will give you a better understanding of how to successfully purchase a home in today's housing market. So until next time, stay happy, stay healthy, and I'll see you on the next show. Bye, everybody.